Are you choosing the wrong strike prices on your options trades? It is one of the main reasons why we see retail traders struggling to hit their trading goals right now. And in today's video, I'm going to walk you through a very simple process for selecting a high quality option. Not just the cheapest option, an option that's going to put the numbers in your favor long term. My name is Mike Rykse. I'm the lead options instructor for Netpicks, and we're going to go ahead and walk through an example here on XLY. This is the consumer discretionary ETF, and we're using a 130-minute time frame. This is the chart that we use for our swing trades. We classify a swing trade as holding anywhere from 1 to 20 days. Now, you'll notice on my chart here, we have all the colored dots. We have a very specific set of criteria that we look for on every trade that we take. And once that criteria is met, you're going to see those dots on the chart. That's why we have the red dots, and I'm putting my crosshairs over here. When that criteria is met for a short trade, we get those entry, target, and stop levels on my chart. The first series of red dots, that was my entry point. My two target levels down below, those are identified by the lower series of red dots. And the white cross up above, that's my stop. Everything's outlined for me in real time. It's either a setup or it's not. And if it's a setup, I know exactly where to get in and where to get out. The system is fully dynamic. Why did I choose these spots for the target and that spot for the stop? The calculator, that's the custom indicator that we've created, does all the reading for me. It takes a look at the range in the market. It determines the size of the setup that is best suited for those conditions. As range expands, as volatility picks up, we're going to be able to go for the larger wins. As markets slow down, we're going to go for smaller wins. We're taking what the market's giving us, and that's going to produce more consistent results for us. Now, you'll see that we came down and we touched the entry point. We did this here on Friday last week, and we just closed out of the trade today. Now, notice what happened here. We had our two moving averages. I did a recent video here this week on our favorite indicators that we use to identify our options trades. The orange and the white lines, those are the 5-period EMA and the 21-period EMA. And we got this short trade because we're looking for a sequence on those moving averages, but also I'm looking for confirmation from our momentum indicator down at the bottom. That's what we call our pulse indicator. And once that criteria is met, that's when we get the short trade. We see price releasing on the downside, releasing some energy on the downside. It's been a while since we've had a sell-off. Really good to see some follow-through here. Now, immediately, when you take a look at XLY, it's a $240 stock. It's expensive. If you take a look at the options, it's tempting for a retail trader to come in and use a very short-term weekly option and go very far out of the money, looking for a cheap trade. Well, those options, they're cheap for a reason. You're not getting a high quality position. You need a lot to go right in your favor to make money. Now, granted, if you do get that directional move, yes, you can make money, and we've been in a very forgiving environment. Right? You can get away with trading the far out of the money options if you're getting those directional moves. We've had a market that just moves higher every day up until this week. Now things are starting to change. Now this is going to be a true test in the months ahead of trading skill. You've got to make sure that you are selecting the right option. So let's take a look at this. If we take a look with our entry point, I'll go ahead and scroll down my data window here. My entry point was at 238.28. All right, so I'm looking at a bearish position. I have my entry point. It was touched. Let's go over to the trade page. And if I take a look at XLY, it's really tempting to want to just open up those 7-day options, those options that expire next week, and then go very far out of the money. Again, I know retail traders, they have access to limited funds. We're seeing a little bit of a funny scenario here. I mean, markets with them being so active after the news this morning, we're seeing some funny quotes here on these out of the money options. But let's just call it let's call it the 220 puts, right? They're trading for 75 cents, roughly, between 75 cents and $1. Very tempting to want to go to that option because now you're tying up, $100 or less potentially. You get a bearish position, not tying up a lot of capital. Seems like a logical way to go. The problem with that is with only 7 days left to expiration, those options are going to lose value very, very quickly, strictly from the time decay. That close to expiration, you better get a directional move in your favor. It's got to be a decent sized move. It's got to happen quickly. That's the only way you're going to make money. If it takes too long, or if the move's not big enough, you're in trouble very quickly. If I take a look at the probability out of the money column here on my trade page, just want to put some context around this. Not just what I think, I'm looking at the numbers. If I take a look at those 220 puts, they have an 86% chance of closing out of the money. So now right there, the odds are against me. I'm fighting those numbers. Right? There's still a 14% chance of that option going in the money. You still can make money on that position. You just need everything to align perfectly. What else can I do to give myself a better probability of success? Well, what we did on this trade is we went to the 235 puts. Okay, we went roughly at the time of the entry point being touched, we went right around the at the money strike. What I'm going to recommend that you do is go to the options that have between 20 and 40 days left expiration. Okay, go out a little bit further. What we did on our trade here with our members, we went out to the November 21st options with 42 days left. Okay, and we opened it last week with almost 50 days left. Why did we go out that far? The reason being, the further out in time that we go, we give ourselves more time to be right. With only 7 days left with those weekly options, I need everything to go right perfectly. By going out over 40 days, now I give myself more time where the time decay is not as significant. That theta is not as big of an issue right off the bat. Now, am I going to pay more for those options? Yes, I certainly am. It's going to tie up more capital, but I'm getting a higher quality position because that time decay is not as significant. And by going closer to the at the money strike, I give myself a higher probability of success. I recommend either going to the at the money strike or one strike in the money, one strike out of the money. Any of those three options are going to be better than going far out of the money. Right? Why? Because right in and around that at the money strike, you're typically going to see the best volume, the best open interest. That's going to make it easier for you to get in and out of trades quickly and at good pricing. And it still gives you the benefit of having some decent gamma. Those options are still going to react pretty quickly to changes in stock price. We came in and we bought, in this case, the 235 puts, this guy right here. Okay, we went ahead and we bought those options last Friday for $5.55. So $555 per contract. Definitely more than those 7-day options, right? Considerably more. But it's actually a safer position. I'm tying up more capital up front, but it's going to limit the time decay right off the bat, and it's going to give me a better chance of taking advantage of a directional move. Now I'm starting to stack the deck in my favor. Right? And in many cases, if you're going to go to the at the money strike, if you're going to go slightly in or out of the money, in many cases, you're going to have between a 50 and a 65% chance of closing in the money versus having a 14% chance with the far out of the money option. Now you're starting to stack the deck in your favor. We ended up closing out of this position here today with our members. We closed it out for $8.80. Just checking my spreadsheet here next to me. It's a $325 return in a week's time. That's a 59% return on my capital. 59% return in a week, fully risk-defined trade. And bottom line, guys, we've been in this trade for a week, and it was really a half a day of selling today. If I go back over to that chart, did we get a massive move to the downside right off the bat? We didn't. We had the trade go against us right off the bat. Wasn't panicking. We hadn't hit our stop yet. No reason to close it out. We held. The system knows better than us, right? It's just strictly looking at price action on the chart. So we drifted sideways a bit, and we finally broke to the downside today. So again, it wasn't a once-a-month move. It wasn't a once-a-year move. These are moves that we see on a regular basis. Again, 1 to 20 days is what I'm looking for. This is a very typical trade. You start to stack these up. You start to take a look at a watch list of products where you're taking a couple trades a week. This can get pretty powerful. So now what we've done is we have a disciplined system in place, exact entry points, targets, stops, and we also know exactly what option to take the trades with. We're going to go either to the at the money strike or we're going to go one strike in or out of the money. We're going to take a look at which option has the best liquidity. That's the strike price that we're going to go with. And it doesn't matter on the call side or the put side, couldn't care less. If we see the market rally higher, we're going to use that same criteria on the bullish side as well. So again, stick with the 20 to 40 day options. Try to go at the money or one strike in or out of the money. You're going to be far better off long term. Now, we do have a live event coming up here in just over a week. We'd love to have you join us. There is a link in the description. Go ahead and click on that link. It's a free event. We're going to be able to go through this criteria in more detail. We're going to walk you through how the indicators work in more detail. That way we can help get you on track with your trading, as we expect markets to be very, very active here the rest of this year. So we'll get that link in the description of this video. If you have any questions, feel free to leave a comment on the video, or you can always email us info@netpicks.com, and we are more than willing to help out there as well. All right, so I'm going to wrap this video up here. Enjoy the rest of your day, guys, and we'll be back shortly with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice, because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpicks' full risk disclaimer and privacy policy.